Hey there, YouTube. So in this video, I wanted to cover qualified opportunity funds, what they are, how they help U.S. individual taxpayers defer capital gains taxes on the disposition of other investments, right? So to start, the QOF investment, it's a fund, like a private equity fund type structure that's invested in what are called qualified opportunity zones. So the federal government in 2017, through the 2017 Tax Cuts and Jobs Act, created these zones that they deemed needed more economic development. Okay, and so in order to encourage the private sector to put capital into these areas, these designated zones provide certain capital gains tax exemptions or deferrals, right? And these are offered to investors that contribute cash to what are also called qualified opportunity funds. So the qualified opportunity zone is the area in the country that's been designated as the opportunity zone. And then the fund is the actual entity that's set up that raises capital from individual investors, and then it puts that capital into those opportunity zones. So what we need to focus on here is if you're an individual investor, you need to find a qualified opportunity fund in order to take advantage of this capital gains tax deferral. So what are the QOF qualifications? Well, first, it's just an entity is first created, right? It's either a corporation or a partnership, or an LLC taxable as either a partnership or corp. Very similar to how you would just set up a private equity fund or a venture capital fund, right? Now, once it raises all the capital and invests that capital in those assets, 90% of its assets on its balance sheet have to be invested in the qualified opportunity zone property. Okay, so once they raise this capital, it's got to be all in these zones, or else they don't qualify for this capital gain tax deferral treatment. And then obviously the entity, whether it's a corp or partnership, every year when it files its tax return, it needs to include a Form 8996, which indicates to the IRS that this is a qualified fund, and we do, our investor base is going to get the capital gain deferral for putting money into this entity. So how does it actually work for an individual investor? An example is the best way to look at this. So John holds a large amount of Apple stock, and he wants to sell his shares. He notices that if he's going to sell the stock, he's got a very large $500,000 gain, long-term capital gain on the transaction, right? And so John's going to pay the 20% long-term capital gains tax, plus he's going to pay the 3.8% net investment income tax. So he doesn't want to pay that, right? So he's looking for opportunities. He finds a private equity company that creates these QOFs. So he decides then, okay, what I'm going to do is I'm going to sell the stock. I made my $500,000 in gain, and I'm going to take all of that cash, the $500,000 in gain, right? He can keep the principal, so whatever his basis was in the Apple stock, he can keep. But it's the gain portion, the $500K. He contributes that to a QOF in exchange for an equity ownership. So let's say he puts in $500,000 and he takes 5% of the fund. Okay, so he's got an equity ownership in the QOF now. On his Form 1040 for that year, he still has to report the $500,000 in gain on the Apple stock, because the broker's going to report that too, right? So the IRS needs to be able to track it. They need to see, okay, you sold Apple stock, made $500,000, and then on the return also there's a methodology to where you can indicate that I took this $500,000 in gain and I rolled that into a QOF. So although I'm reporting it all on my tax return, I'm basically backing out or deferring the $500,000 in gain I had on the Apple stock. And so I have another video. I'll put a link below to where we go over kind of how to report that. But that's effectively what happened. So John gets to defer the $500,000 in gain, and he doesn't later recognize that gain until he redeems his interest in the QOF, or the program expires, right? So the QOF program does have a shelf life on it. It was supposed to be 10 years. So at some point it's going to expire unless they decide to extend this program. But the gain recognition under the rules is it's the earlier of the day you redeem out or sell your interest, or the expiration of the program. So So yeah, eventually, yeah, you're going to pay the gain, but a lot of tax planning is about deferral, right? How do I pay tax 5 years from now on money I made today? That's the name of the game. So that covers it. Pretty straightforward. Very good planning tool for investors that are looking to liquidate large stock portfolios and don't want to pay the gains. So yeah, thank you again for watching. I hope that was helpful. If you have any questions, please leave me a comment below. And also check out the other video I have on how to actually report this disposition and deferral on a tax return. Okay, that covers it. Thank you so much, and I hope to see you again soon.